All right, what's up, everybody, and welcome to today's webinar on our current investment offering. JKAM is dedicated to creating passive income and growth through private real estate opportunities, giving you a better way to build wealth without Wall Street. We have to start first with a disclaimer, and this is being recorded, so if you want to read this in its entirety, you can review it at a later time. But essentially, this is not an opportunity to invest. You must first read the private placement memorandum in the subscription documents, and this is only appropriate for accredited investors. Great, so why JKAM? Well, it's JKAM's mission to connect our community to private alternative investments, providing cash flow appreciation and tax benefits. Since inception, we have helped our community participate in over 40 properties, totaling over 13,000 doors, and in 23 different metro areas. Jack Ruppy and I founded JKAM Investments. So Jack has navigated the investment world for over 20 years and has been around the block more times than I can count. His career has been defined by successfully navigating and pivoting during financial crises. Like most, he started his career believing that Wall Street is where wealth happens, still between working there and surviving the dot-com bubble burst of 2001 and the housing market bubble burst of 2008. He realized that Wall Street investments alone are far too fragile and would never help him attain his financial goals. So he leaned into his previous experience and knowledge as a real estate broker, wholesaler, and landlord to pursue alternative assets, not just in the form of real estate, but also in oil and gas, private equity funds, private lending, venture capital, and other niche asset classes as a way to prepare for future economic turmoil, all while continuing to build his personal wealth. Myself, my name is Bonati. I've been an entrepreneur since 1998. I am proudly an ex-financial advisor. In 2014, I started Infinity Asset Ventures, which was focused on investing in distressed residential single-family homes nationwide. In 2016, that company, or my company, acted as the exclusive disposition trade desk for Jack's distressed debt fund. It's a portfolio of over $3 billion in assets. And then in 2020, Jack and I teamed up with longtime friend and colleague, I teamed up with longtime friend and colleague Jack to share with investors a way off the stock market roller coaster and towards true financial freedom. Beyond Jack and I, the JKAM team is supported by Yumi Min, acting as CFO. She brings diverse corporate experience from auditing, compliance, finance, and strategy. Zach D brings his experience from a registered broker-dealer, developing client due diligence and onboarding processes, also bringing extensive strategy and compliance experience to lead investor relations and operations. And finally, Zach G, who is a client-centric connector and brings his experience from various ventures in tech, real estate, and agriculture, raising over $100 million in capital for various ventures to be our investor relations associate. JKAM's team is also fully supported by professionals who know their stuff. So we have relationships with established firms, including fund accounting through Strategic Fund Services, third-party oversight through Verivest, which does things like background checks on principals and verifies fund holdings. Our legal is through Fisher Boyles. And finally, we have tech-forward investor portals through Avestor and Syndication Pro. These platforms allow our clients to view fund project updates, tax documents, and all fund and project documents. So the sponsor and operator of this opportunity is Lone Star Capital, and I'm excited to have joining us today Rob Beardsley. Good afternoon, Rob, and thank you for taking the time to join us today. Can you share with us you and your team's background?
Sure. Yeah, would love to and happy to be here. So my business partner, Kent Petrikovsky, and we started Lone Star Capital nearly 5 years ago to focus on owning and operating Texas workforce housing. And ever since then, we've done just that. We've acquired over $350 million in multifamily properties in Texas, primarily in Houston. Also, we were really excited last year in the middle of 2021 to launch our new property management company, Radiance Living. So we operate our portfolio in-house, property management, in-house construction, and that has been a very big key to our success, both focus on the acquisition side as well as on the operational side.
Right. So Lone Star Capital, guys, is a fast-growing real estate investment firm Like Rob said, with over 300 million in acquisitions, you guys have done over 30% returns since 2008, right?
Yes.
And like us, beyond their core team, they also have relationships with trusted tax, insurance, legal, and accounting professionals who contribute to smooth deal execution. So, Rob, why don't you briefly run through your track record here for our viewers?
Yeah, absolutely. So you can see at the very bottom, the two disposed assets were in Houston. Those had an average hold period of around 3 years. And as you can see in the very bottom right, you can see the average IRR is about a little over 30% on those two sales. We currently have 10 properties in the portfolio right now, with 9 of them being in Houston. So we're very Houston focused and have built up an expertise in the market, as well as a local team to operate the properties across the portfolio. And our management team notably only manages our properties. We do not do any third-party management business.
Awesome. So you see some really good operational efficiencies there. Great. So why don't we get into the meat of this opportunity? We're here to share the current opportunity, which is Madison at Bear Creek, which is also in Houston, Texas, West Houston specifically. So jumping right to the chase on why JKAM likes the deal. There's immediate monthly distribution. So this deal closes in November. So December's distribution is paid in January. There's multiple exit strategies. There's a projected 3-year hold period, but the debt term is 7 years, which allows for some flexibility with the exit strategy. It's a full value add. So 100% of the units are in classic condition, meaning there's plenty of value add that can be captured through renovations. The pro forma renovated rents for this asset remain $400 to $700 below Class A rents in this submarket. So LoneStar, as Rob just mentioned there, owns a lot of properties in Houston, but most notably one next door, allowing for cost reductions and property management synergies across both of those properties. There's also strong occupancy in the Bear Creek submarket. So it's a really tight submarket. There's not a lot of new supply, and there's a 97% occupancy in a 1 mile radius. And this particular property maintains a 98% occupancy, with the year one break even occupancy at 85%. There's also the opportunity for lease renewal value capture. So below market rents allow for lease renewal value capture in the current classic condition units. There's also sponsor buy-in. So Lone Star Capital equity partners are personally investing 4% of the total equity. And finally, it's tax advantage. So 60% depreciation, or 60% year one accelerated bonus depreciation. So I'll run through the key investment details here. Again, we're pleased to present the Madison at Bear Creek. Again, it's 180 units built in 1982. It's in Northwest Houston. The units are 13%, 56%, 31% mix of studio, 1 bed, 2 and 3 bed floor plans, with the average size of 769 square feet at $1,015 monthly rent. Lone Star, our operating partner, has previously transacted with this brokerage group and already owns in Bear Creek. So those were key factors in reassuring the seller and securing the deal. The Timberwalk Apartments, which is another one of our investments, again, is right next door, and Lone Star Capital's local knowledge and hands-on attention will support the execution of the business plan. All the units will be renovated to luxury finish with quartz countertops, black appliances, tile backsplash, lighting improvements, washer and dryer, and smart door locks, plus climate control. The rent comps have seen a 13% rent growth in the past year, and the future growth is projected at $222 over the investment hold period, with an annual growth elevated over 4% through 2026. So Bear Creek specifically is a quality mid-upper workforce area with extensive single-family residential, as well as national retail on Attucks Salsuma Road. which is nearby Copperfield. It's also conveniently located to Houston's major employment centers with access to Northwest Freeway I-10 and the job-rich FM 1960 corridor. Per neighborhoods.com, the median home sales price in Bear Creek Village is $231,000. And Madison at Bear Creek offers strong value add returns targeting 15.8% net IRR and a 5% average cash on cash over 3 years. Purchase price is $19,950,000. Senior loan is $16 million, which is 68% loan to cost. So total capitalization is $26 million. CapEx budget is 3.3. And finally, again, the units is 180. Occupancy is 98.3, which is awesome. So I went through a lot there, right? Pretty quickly. Bob, can you speak a little bit to the business plan and financing and how this has changed over the last year in the marketplace there?
Yeah, sure. So one of the things that is most exciting about this deal is the fact that we're buying from a long-term owner. The previous owner bought the property 11 plus years ago, and while they maintained the asset in decent shape, they did not invest any capital into the interiors. So we're talking about very classic interiors, and that are 100% of them are untouched. So there's a lot of meat on that bone to go in there and renovate the units to bring them up to market rate in order to capture a substantial rent premium. With that in mind, even without renovating, there's a loss to lease factor. So the rents are low even for the current condition of the units, which presents a really great value for what we're buying. And then, like I said, you layer on the renovations on top of it, and now you've got a really big value add proposition. So that's one of the most exciting things about it. Also, what you touched on before is the fact that we own Timberwalk right next door, which is 300 units. So putting them together, that's 480 units, which provides good scale and will allow us to run the properties more efficiently from a payroll and maintenance perspective.
Mm-hmm.
Some other interesting things in the business plan that are going to create a lot of value are adding in washer dryer machines into all of the units, as well as connections where needed. I believe there's only about 24 units that currently lack connections. And so we'll be making the connection and then installing also the washer dryer machines so that they'll be in every unit throughout. And washer and dryers always garner a very strong return on investment in multifamily value add. Another thing that we like to do and have identified here is a smart door lock and smart climate control amenity feature. So basically a tech package for the units, which gets a monthly premium and enhances kind of the perceived value and level of the property.
Yeah.
Finally, for other income, we are adding 65 carports, which are projected to add $50 per carport per month in other income.
Awesome. And you've seen that work on your other properties?
Yes. All three of those strategies, washer and dryers, extremely successful. Smart home tech package we have done on a couple properties, and then carports are also a great way to generate other income, whether it be reserved parking, reserved and covered, or covered unreserved. There's different ways to go, but that adds a lot of value for the residents, and they're willing to pay for it.
Yeah.
And I was just going to add, we're projecting to accomplish all this over 24 months, which is fairly conservative. Our team believes they're able to implement a project like this in about 18 months. So we anticipate, beating that projection, but we normally stay conservative and use 24-month timeline for renovation.
Yeah, awesome. Thanks for sharing tons of different ways to add value here to this property. We've been getting a lot of questions from our clients concerned about the exit with cap rates and interest rates rising. Can you talk a little bit about the financing and sort of potential exits?
Yeah. So we have a very attractive loan in place for Madison at Bear Creek, which gives us the best of both worlds. This is a 7-year bank loan, which is important because 7 years is lots of term in order to implement the business plan and ride out any economic downside. All right. So we don't have a short-term loan with maturity risk. Secondly, the loan is at SOFR plus 2.75%, which is also with a 3-year rate cap at a 3% strike rate for the first couple of years, and then a 3.6% strike rate for year 3. So we essentially have a 5.75% interest rate for the first couple of years, which is attractive while we implement our business plan. Also, the first couple of years are interest only, which maximizes cash flow. But it all in all is a very conservative loan because we are levered at less than 70% loan to cost. So as we go in there, spend the money, increase rent, and create value, we'll even further reduce the amount of leverage effectively on the property because we'll be increasing the value of the property while the loan begins to amortize at the end of year 2. So we'll be paying a small portion of the loan down every single month after 2 years.
So by forcing appreciation in value, you're effectively reducing the loan to value, the loan to cost.
Exactly.
That eliminates a lot of your refinance risk if loan to values get even more conservative or interest rates go up even more. It sort of mitigates a lot of that risk.
That's the number one risk and number one concern. We feel really good about the position of that debt and on this asset. The other side of it is that we are retaining flexibility. So there is a very modest prepayment penalty associated with being able to sell in 2-3 years. So that means that if we perform well and the market's performing well, we can take advantage of it and sell early, and we're not locked into a long-term loan if we don't want to be. So that's really important in order to maximize returns.
Excellent. Thanks for sharing that point, because a lot of times those prepayment penalties can be pretty hefty on those longer-term loans. So that's really good to know. Thanks for sharing. So we already went through, or you already touched on a lot of the value enhancement plan, and this is pretty standard for Lone Star projects. So I don't think we need to touch on this any further. But again, it's unit upgrades, washer dryer machines, smart home package, and carports, common areas. So talking about the investment returns, so limited partners are owed a 9% preferred return. Any shortfalls in this pref payment will accrue and compound at the preferred return rate. Upon a capital event, so that's a refinance or a sale, investors are first entitled to their preferred return and then 100% return of their original capital. Thereafter, any excess proceeds are split 70% to LPs and 30% to GP. Equity shareholders receiving 9% pref with a 30% promote. Investors receive 100% of ongoing cash flow, as well as a compounding 9% IRR-based preferred return above the full return of initial investment before any performance incentive is paid to the sponsor. So that's a mouthful, but essentially your incentive is aligned with LPs, and then it motivates for performance, right?
Yeah, that's right. And we're taking all the risk off the table for investors before we participate in any of the profits, right? Just simply by the fact that they need to earn their compounding 9% return and get their original investment back to have all their risk off the table. And then we share in the remaining distributions. Yeah,
that's awesome. So there's a 2% acquisition fee and a 2% management fee. Here's an example of what a $100,000 investment looks like over 3 years. So 100 to 152,000. And our JKAM community and investors receive better terms, typically reserved for investments of 500,000 or more, but are accessible through JKAM for a minimum of 50,000. So again, our community is getting the better terms at a lower minimum there. So moving on now to the property overview. So that's some computer issues. There we go. All right, it's done thinking. All right, Rob, can you speak to the current units? Let's go back there real quick. All right, yeah, current units. and the planned upgrades and why this presents such an upside.
Yeah, as you can see through the top two pictures, the current condition of the units is they're in okay shape, but they're very classic. So with old flooring, old countertops, old white appliances, the cabinet fronts don't have any hardware, lighting package is dated. And then you can see the intended upgrades in the bottom two pictures with new modern flooring, different color palette with hardware on the cabinets, new black appliances, and a hard surface counter with backsplash in the kitchen. So that totally transforms the apartments and really goes a long way in getting a big ROI on increased rents.
Yeah, makes sense. And then the exterior, what plans do you have for the exterior?
So like I said, the owner kept the property in decent shape, so there's not a ton to do in the exterior, but we're doing some minor repairs like parking lot repairs. There's some siding repairs, but all in all, the property is in pretty good shape. There is a dilapidated, unused kind of sport court just off behind and to the right of the leasing center. So we'll be repurposing that and determining the highest and best use of that area after we interview the residents. But just looking at the bones of the asset definitely makes me feel very comfortable. It's a early 80s vintage product, but it has pitched roofs, copper wiring, copper and PVC plumbing, and individual HVAC. So no red flags as it goes, as far as the bones are concerned. Actually, very good, solid bones.
Yeah, awesome. Thanks for sharing. And from this slide, it's clear what the Lone Star's plan is with the amenities. But maybe you could share with us your thoughts around why this really drives additional value and what you've seen with your other properties in the market.
Yeah, I think at the end of the day, a lot of it comes down to leasing advantage. As you probably know, not a ton of people use the gym near the leasing office or the playground for that matter. It just depends on the community. Not all amenities are heavily used, but they are very effective for leasing. So everyone likes to go by the pool, and you need to have the pool look very inviting and clean because it reflects the community, the greater community. So some other fun things that we have done, as you can see in the bottom middle left picture, the small laundry facility, that will be repurposed because we'll have rolled out the washer and dryers across all the units. So with in-unit washer and dryer across the property, there won't be a need for a laundry facility such as that one. So we'll actually be able to repurpose it. And something fun that we've done recently at another property was turn it into a pet spa. There's already plumbing for water, and so it's easy to create kind of like a inside pet washing station or pet spa. So whether the residents actually end up using the pet spa, right, it's to be determined. But when people go on a tour and they see that, oh wow, that's so fun, and they can picture themselves with their dog living at the property.
Yeah, it makes sense. And are pet owners more revenue for the property? Like, do they pay a premium?
Yes, there's a pet fee upon move-in and a pet deposit, as well as a monthly pet rent.
Yeah. And with that new flooring, was it the faux wood? It's like indestructible, so perfect for pets.
Yep.
All right. So looking at the unit mix, how should our viewers be looking at this, and what are the key takeaways?
The key takeaways are you can see the in-place rent and versus the pro forma rent. So we're targeting a pretty substantial rent increase. But if you look at the rent comps, it's still in line with the market based on other renovated product in the neighborhood. Also, there's a natural, like we talked about before, loss to lease that exists at the property. The property is currently 100% occupied. So it's definitely with the rents are too low given the fact that it's full, and there's been so much rent growth in the past year or two in this submarket that it's hard for any manager to keep up with that rent growth. So naturally, it creates a loss to lease. So capturing that loss to lease as well as doing the renovations, getting us up to those pro forma rents. However, like you said from the very beginning slide, our renovated rents are still $400 to $700 less than the newer Class A product in the market. So we're not trying to be something that we're not. We know that we're workforce housing, and we want to keep it workforce housing and keep it affordable. And so based on the fact that the median household income in the area is $60,000, these $1,200 projected rents are still affordable based on that income level.
Yeah, awesome. So jumping into the market overview, which again, Rob and Lone Star are very familiar with because obviously you got another property within a mile of this one. But maybe you can talk about why the submarket is so great. What's compelling about Bear Creek?
Yeah, it's one of our favorite submarkets, and we've owned in the submarket for over 3 years. We like it because it's a very stable workforce housing submarket, which is exactly what we target. And one of the benefits of that is it doesn't really attract a lot of new development. Developers are focusing on more glamorous, more, high income areas. So there's very little new supply risk, which is fantastic for us. And that is evidenced by the fact that the street, the 1 mile radius, is 97, 98% occupied.
Yeah.
Right. There's just a lot more demand than there is supply. So everybody stays full. And when you stay full, it makes growing rents every year that much easier. So we've experienced very strong rent growth over the last 3-4 years here, and anticipate that trend will continue, although we are not underwriting that fully into our projections. Our projections stay conservative at 3% per year rent growth, but Yardi has 4% plus annual rent growth projections. And I even personally think that could be beat just given the inflation that's in our market right now.
Yeah, makes sense. So this is a map overview. You can see Madison on Bear Creek right there in its proximity to the Houston City Center. Again, it's a great location in terms of proximity to highways. Looking now into the investment analysis. So for those of you who don't know, Rob is the author and publisher of the #1 definitive guide to underwriting multifamily acquisitions. So a credible source here. Looking at the rent comparables, how should our audience be interpreting these comps? And I guess, why do you think you'll get a premium to the average here?
So one thing I forgot to mention is the fact that the neighborhood is just now experiencing a lot of new renovation. So not a lot of this product that you see in front of you is renovated assets, but a lot of new owners are coming in and investing capital into the submarket because there is a demand from the residents for nicer, newer units. So what people should focus on here are a couple things. First off is Bear Creek Crossing. You can see Bear Creek Crossing, which is just right a couple doors down from Madison at Bear Creek. And Bear Creek Crossing, you can see, is also very highly occupied, and with smaller 1 bedrooms, for example, is getting higher rents than what we are currently getting. And Bear Creek Crossing is totally unrenovated. So that shows you kind of the in-place value proposition at Madison Bear Creek. And then to justify the upside, I would focus on Town Lake. Town Lake also is very occupied, and they have about half of their units renovated to a similar finish to where we're going to take our units. And those units are completely full, and there's a waiting list for those units. And those units are renting at higher than their 1017 average. Yeah. And that's why we feel comfortable targeting 1070 for our 1 bedroom rents. So that's just, one example of our rent comp story here.
Yeah, awesome. Sales comparables. Again, what should our viewers take away from these comps?
So, we're acquiring the property for just under $111,000 per unit. To me, that feels like a very good basis. If you look at Pine Forest, for example, which is 2 miles away, that was purchased in February at $126,000 per unit, or $162 bucks per foot. Mm-hmm. And we are at a decent discount to that, even though we're about the same age and condition, if not in currently worse condition. The other really notable thing about price here is the fact that we're buying at a 4.93 cap. That is a really nice going in cap rate considering all the value add that we have in front of us. Typically when you are buying a true long-term owner like this with a big value add, you're going to be paying a premium, which means a lower cap rate in order to have a chance at that upside. But here we're getting in at a good cap rate and we have the upside. So I feel good about the basis.
Yeah, great. Thanks for sharing. All right, and then looking at the pro forma financials, again, what stands out to you here? What should our viewers be keyed in on? And then finally, like what's different from last year's acquisitions? Is there drastic changes?
So I wouldn't say there's a ton different from last year's acquisitions. We like to keep our underwriting fairly conservative and consistent, but certainly the debt is a big change from the year before, and we already covered the debt here. It's lower leverage, long term. You really got to feel good about the debt here. But one thing I'd like to point out is we're actually projecting a 7% decline in NOI from the trailing 12 months versus our first 12 months of ownership. And there's a few reasons for that. First off, we like to be conservative early on and not get carried away, because if you are aggressive with your year one numbers, that carries over to year two and beyond. So that's one factor. The other factor is property taxes. It's always better to be conservative about the reassessed property tax value. And so we usually come out ahead of where our projections are for the first year, at least for property taxes. So you can see we are projecting to escalate property taxes quite a lot from the trailing number to the year one pro forma. And so hopefully we will come out ahead there. So yeah, that's kind of the first story. But at the end of the day, we're pursuing a big value add program here and hoping to get a lot out of the renovations for revenue and income increases. So you can see, in year two and beyond, we're projecting, pretty large revenue and income increases, which is how we are creating so much value, right?
Mm-hmm.
Not, but basically forced appreciation.
Yeah, it's pretty incredible how much value you can create. When you're raising rents by $200 to $300 on a 180 unit building. Cool, awesome. Thanks for sharing. Sensitivity analysis. A lot of our clients really like to dig into this. And everyone, as I said, is talking about in interest rates and inflation. And maybe you could speak to those factors and how that could impact this project, and speak to the sensitivity analysis and sort of worst case, best case, what that looks like.
Yeah, absolutely. So as you can see, our base case, and this is actually a little bit outdated for, not to go off track here, but we actually got a $1 million price reduction, as a couple weeks ago. And so, the price was correctly updated earlier, but we didn't actually correctly update this because we had the ability to get more conservative with our exit cap because of the lower price, rather than just trying to be more aggressive and project higher returns. So actually our base case exit cap rate is about 5.42. So, nearly 5.5% exit cap rate, which I feel very comfortable with. But you can see, simply the stressor on the exit cap side, as well as rent growth. So if we do match the Yardi projections of, let's say, 4% plus per year, and we get that for a couple of years, we're in store for obviously stronger annualized returns or equity multiples. However, if we are in a situation where cap rates do expand and we exit for 5.75% or 6%, that's going to eat away at some of that. So yeah, you can see the upside and the downside, but at the end of the day, the important thing is to note that we're not forced sellers here. That's the luxury of having 7 years of debt term. So we don't, just because the cap rates expand and we can't sell for the price that we want, it doesn't mean we have to sell. We can hold and continue to cash flow the asset and wait for the most opportune time to sell.
Yeah. Great. Thanks for sharing. And maybe you could just speak to this real briefly as well. I think this is the last of our slides here. So.
Yeah, so these are tables are for the first year cash on cash, as well as the average over the 3 years for cash on cash returns. And you can see that I do believe that we will definitely be at that 5% vacancy mark, if not tighter, just given where the average is in the submarket.
Mm-hmm.
You know, of course, we never project to have vacancy less than 5%. So I think there's a good chance that we beat that. However, in a downside scenario, we will certainly, it's certainly possible that we'll experience higher vacancy temporarily in a recessionary environment, for example. But as you can see, that still leaves, we still have positive cash flow in a downside scenario. So the cash flows are pretty resilient here.
Yeah, great. Awesome. Thanks for sharing. Cool. All right, guys. So next steps and timeline is this launched in November 8th. Reservation deadline is November 25th, and funding deadline for us is December 1st. Thank you all for joining us today. If you guys have questions, comments, or feedback, we'd love to hear from you. Rob, thanks again for your time and really jumping in and sharing the details on this project with our audience. If you guys would like to see more info on this opportunity, you can make a reservation in the email that this recording is included in. And you can also go to jkaminvestments.com/news/Madison at Bear Creek to make a reservation there as well. So thanks again, everybody, and make it a great day.